$114 trillion. That's how much money sits inside one single organization most people have never heard of. It's called the DTCC, the Depository Trust and Clearing Corporation. And it's basically the central vault for almost everything that gets traded on Wall Street. Stocks, bonds, money market funds, all of it. Now here's the part that should make you sit up. The DTCC is moving that entire pile onto a blockchain. 10 years ago, that sentence would have been a joke. Banks and blockchain were enemies. Bitcoin was supposed to replace the financial system, not get adopted by it. But here we are. BlackRock CEO Larry Fink is calling this the next generation of finance. The SEC just greenlit a 3-year pilot. The conversation has flipped completely. So today I want to walk you through what's actually going on, because both sides of this story, the celebration version and the cynical version, are missing something important. Let's start with the word itself, tokenization. You hear it everywhere in finance right now, the same way you hear AI everywhere in tech, which means it kind of means everything and nothing at the same time. Here's what it actually means. You take something real, a building, a stock, a bond, a painting, and you create a digital version of it on a shared computer network. The digital version is the token. The token is your proof of ownership. That's it. Why does this matter? Because it changes what you can actually do with what you own. Take a building, a really expensive one, a glass skyscraper in Manhattan or London or Singapore. Historically, only big institutions could own a piece. Pension funds, sovereign wealth funds, the very wealthy. The check size to get in was enormous, the paperwork was brutal. And if you ever wanted to sell, you'd hire lawyers and wait weeks, sometimes months. Now imagine you take that skyscraper and you break it mathematically into 1,000 digital bricks. Each brick is a token. Each token says, the holder owns 1,000th of this building. Suddenly you don't need to be a pension fund. You can buy one brick. You can sell it at 3 a.m. on a Sunday to someone in another country in seconds. Same logic works for a Warhol painting. Same logic for shares in a private company that's never gone public. Assets that used to sit frozen for years can suddenly move. That's the promise. Hold on to the word promise. It's doing a lot of work in that sentence. Here's the part of this story you almost never hear. The thing that's actually making Wall Street move. It's not idealism. It's not democratization. It's not power to the people. It's cost savings. That's the whole thing. Let me show you how broken the current system is. Right now, every bank, every broker, every clearinghouse keeps its own private record of who owns what. Their own internal spreadsheet. When you buy a stock, your broker writes it down. The seller's broker writes it down. The clearinghouse writes it down. The custodian writes it down. 4 records. Same trade, different systems. At the end of every day, those records have to be checked against each other to make sure they match. They often don't. So there are entire departments at every major bank whose only job is to find the discrepancies, investigate them, and fix them every day, forever. This costs the industry billions of dollars a year. And it's slow. When you buy a stock today, the trade doesn't actually finalize for a day or two. During that window, money is locked up. Risk piles up. If something goes wrong, somebody's holding the bag. A shared digital ledger collapses all of that. Instead of every institution keeping its own spreadsheet, everyone permitted to participate sees the same master list. Every transaction gets added in real time. Every computer on the network confirms it. No more reconciliation because there's nothing to reconcile. No more multi-day settlement because the ledger updates the second the trade happens. And then, this is the cool part. Now you can build instructions directly into the tokens. The token doesn't just sit there as a static certificate. It carries rules. Own a token that represents a piece of a building. Program it so the second the building collects rent, your share flows into your wallet automatically. Own a token representing a bond. Coupon payments happen on schedule by themselves. No invoicing, no middlemen. The token just does it. You can stack these things too. Use one as collateral for a loan. Bundle them. Swap them. The asset becomes programmable in a way paper just never could be. That's what's drawing Wall Street in. Not the dream of decentralization. The prospect of automating away enormous chunks of overhead in one of the most expensive back-office systems on Earth. Quick tour of how a tokenized asset moves through the system. You'll see the same diagram in every industry deck on the topic. It starts with deal origination. Someone decides, okay, we're going to take this asset, this loan, this treasury bond, this slice of a building, and turn it into tokens. The asset gets structured. Legal terms get defined. Then it gets minted. Technical word for the tokens get created. The tokens go out to investors. They start trading. Fast, global, around the clock. While they're held, the platform handles all the boring stuff automatically. Dividends, interest, voting rights. The token knows what it owes you. The token pays you. At the end, at maturity, the tokens are burned, destroyed. And the principal goes back to whoever held them at that moment. If you're an institution managing trillions of dollars, automating that entire cycle saves billions. Not millions, billions. That's the real number. That's why this is happening now. It's not Larry Fink being visionary. It's a spreadsheet that shows the savings. And once the spreadsheet talks, the transition becomes inevitable. Okay, this is where the story gets more interesting and a lot less simple. If you've been listening to the crypto side of the internet for the last decade, you might be expecting me to say, and And so the banks finally surrendered. Decentralization wins, power to the individual. That's not what's happening. It's almost the opposite. And you have to look at the design details to see it. In December 2025, the SEC granted the DTCC, same central vault we started with, a 3-year pilot to start tokenizing things like the Russell 1000 and US Treasuries. Sounds revolutionary, right? Read the fine print. Transactions are only allowed on approved blockchains. They have to flow through registered wallets. Every participant has to clear rigorous compliance screening. This is not the wild anyone can join public blockchain of the original Bitcoin vision. This is a private club with a guest list on a network the central authority controls. And here is the detail that, for me, says more about what's actually being built than anything else. The DTCC has retained the technological power to reverse any tokenized trade. They have an undo button. If something goes wrong, a hack, an error, a regulatory issue, they can roll the transaction back. Just rewind it. Now that might sound reasonable. In a lot of contexts, it is reasonable, but it directly contradicts the single most important property of a public blockchain: immutability. The whole point of Bitcoin, the entire reason it was built, was that no central authority could ever reverse a transaction. The ledger was supposed to be final. Absolute. The technology was specifically designed to make an undo button impossible. What the DTCC is building, and what the Bank for International Settlements is now championing globally as a blueprint, is taking the technology of decentralization, keeping the parts that make it efficient, and surgically removing the part that made it threatening. They call this approach a unified ledger model. It has the speed of blockchain, the automation, the programmability, but it strips out the decentralization. It strips out the anonymity. It strips out the immutability. What's left is a really fast, really programmable database that the central authority still fully owns. People in the industry have started calling these systems walled gardens. They have the aesthetic of crypto, so distributed ledgers, smart contracts, tokens, but they're permissioned environments run by the same institutions that always ran the financial system. The technology has been domesticated, the legal time bomb. There's another layer here nobody's really talking about, and it's where this whole system could get stress tested in ways no one's thought through. Tokens have to be connected legally to the real world assets they represent. The token says you own a piece of a building, but there's also a legal entity somewhere, a custodian, a trust, a registry that holds the actual deed. So you have two parallel systems of ownership running side by side, the digital on-chain version and the legal off-chain version. In the perfect case, they always agree. But what happens when they don't? Imagine a tokenized asset gets stolen in a hack. The hacker now controls the token, the blockchain shows them as the owner. But the underlying security, the actual bond or stock, is still being held in trust by Citi or some other legacy custodian. Legal record. Those two records now disagree. The blockchain says one thing, the legal custodian says another. Who wins? Courts have basically no precedent for this. The Financial Stability Board and IOSCO, the global bodies that try to keep the financial system from blowing up, have publicly warned that current laws aren't equipped to handle this kind of hybrid digital and physical reality. So the technology can be perfect, the math can execute flawlessly, but the legal system underneath, the system that actually decides who owns what when there's a real dispute, is way behind. That gap is going to get tested. We just don't know yet what the precedent will be when it does. Now, let me lay out who's actually winning and losing here, because both sides of the argument tend to oversimplify it. The crypto purists are losing this round. The people who built and championed this technology because they believed in a decentralized, permissionless financial system, their technology got adopted, yes, but on terms that strip away the features they cared about most. No decentralization, no permissionlessness, just a faster, more programmable version of what already existed. Back office workers are losing too. Armies of reconciliation clerks, settlement specialists, paper processors, their jobs are being automated out of existence. Real efficiency gain for the system, real human cost. Both are true. The big winners are the institutions that already run the financial system. The central custodians like the DTCC, the asset managers like BlackRock, the vendors building the rails. They keep their authority, they keep their gatekeeping role, and they capture all the operational savings on top. They've used blockchain to consolidate their position, not to disrupt it. But here's the part the cynical point of view leaves out. Regular investors do gain something real if tokenization actually opens up access to assets that used to be locked away. Fractional ownership of real estate, of private equity, of high-value collectibles, that's a meaningful expansion of what an ordinary person can invest in. It's not radical democratization. It's not everyone becomes their own bank. But it's also not nothing. It's a real, if modest, broadening of access. Whether that's enough to call this story a win for the public is genuinely a judgment call. Reasonable people will land in different places. So where does all of this leave us? Something genuinely strange is happening. And neither the celebratory point of view nor the cynical point of view really captures it on its own. The technology of decentralization, built specifically to bypass institutions, designed by people who didn't trust the system, is being absorbed into the most centralized financial infrastructure that exists. The institutions aren't surrendering, they're upgrading. And in upgrading, they're carefully taking the parts of blockchain that serve them. The speed, the automation, the savings, and quietly leaving behind the parts that ever threaten them. The undo button stays, the walled garden stays, the gatekeepers stay. They just have better tools now. At the same time, real things are changing for the better. Settlement is getting faster. Illiquid assets are becoming tradable. Operational waste is getting squeezed out. Investors who were locked out are getting in. Those are real benefits. Dismissing them is just as inaccurate as overselling them. Here's what I want you to watch for as this rolls out over the next few years. The question is not whether tokenization happens. That's a foregone conclusion. The question is what kind of tokenization we end up with. Who writes the code? Who holds the keys? Who decides what gets reversed and what stays final? Those aren't technical questions, they're political ones. And the answers, most of which are being decided out of public view in rooms most of us will never see, are going to quietly shape the architecture of finance for a very long time. Thanks for watching. Pay attention to who's holding the keys. Consider subscribing to the channel. I'll see you in the next one.